U.S. housing market is not doing so hot. And in today's video, you and I are going to be reading through an article from TradingView discussing just how bad the U.S. housing market really is and why things may not be getting better anytime soon. Now, with that being said, if you enjoy this sort of content, economics, investing, cryptocurrency, politics, subscribe to the page. And with no further ado, let's dive in. U.S. new home sales expected to slow in October after September jump. U.S. new single-family home sales are expected to slow to a 725,000 annual rate in October, based on a survey compiled by Bloomberg, after rising by 4.1% to a 737,000 rate in September. Sales would still be well above the 673,000 annual rate reported in October 2023. Okay, so up. Maybe I was mistaken. Maybe I misled you. Perhaps. New home sales are up in comparison to last October, but let's continue. The data are scheduled to be released at 10 a.m. Eastern Time Tuesday. That would be tomorrow at the time of this recording. You'll probably see this after, so you may know more than I do right now. Supply of new homes for sale was well above its year-ago level in last month's report for September, while prices were only slightly higher than a year earlier. Recent mortgage application data from the Mortgage Bankers Association, say that 5 times fast, have shown that mortgage rates rose through October and moved higher in November after the election. The reason why is because bonds were going up, and mortgage rates are tracked by the bond market. The bond market, the yield that you see, will correlate to mortgage rates. So the higher the yield, the more mortgage rates are. The lower the yield, the lower mortgage rates are. That's why during the 2010s, you were able to get mortgages for 2%, 3%, basically nothing, free money. If you're Zuckerberg, apparently he got a mortgage for 0.5% or something, basically nothing. You could do that when interest rates are low or zero during the 2010s. But when they're 5.25%, now down to 4.5%, they're a little bit higher. Let's continue. Supply of new homes for sale was well above its year-ago level in last month's report for September, while prices were only slightly higher. Recent mortgage applications show that mortgage rates rose through October. Home building... The U.S. housing market is not doing so well. And in today's video, the U.S. housing market is not doing so well. And in today's video, you and I are going to be reading through an article on TradingView discussing just how bad the market is and why things may not be getting better anytime soon. Now, with that being said, if you enjoy this sort of content, economics, investing, cryptocurrency, and politics, subscribe to the page. And with no further ado, let's dive in. U.S. new home sales expected to slow in October after September jump. U.S. new single-family home sales are expected to slow to a 725,000 annual rate in October, based on a survey compiled by Bloomberg, after rising by 4.1% to a 737,000 rate in September. Sales would still be well above the 673,000 annual rate reported in October 2023. Maybe things are good. Hold on. We have an improvement from last October. What's going on here? Let's continue. The data are scheduled to be released at 10 a.m. Eastern Time Tuesday. That would be tomorrow at the time of this recording. Supply of new homes for sale was well above its year-ago level in last month's report for September, while prices were only slightly higher than a year earlier. Recent mortgage application data from the Mortgage Bankers Association, say that 5 times fast, have shown that mortgage rates rose through October and moved higher in November after the election. Yes, because when the bond market moves, the mortgage rate market moves. As in, the higher bond yields are, the higher mortgage rates are going to be. The lower bond yields are, the lower mortgage rates are going to be, because mortgage rates track the bond market. Where the bond market goes, mortgage rates follow. It's a little bit of a lag, but that's how it works. That's why during the 2010s, you were able to get really cheap mortgages, and why now mortgage rates aren't so cheap, because bonds are cheaper, but the yield is higher, and that's what matters. Home building data for October released on November 19th showed declines for building permits, housing starts, and home completions. The National Association of Home Builders reported on November 18th that builder sentiment improved in November due to expectations for lower regulatory burdens under the Trump administration that are forecast to boost home building. Single-family existing homes sales rose by 3.5% in October and were up 4.1% from a year earlier. The National Association of Realtors reported on November 21st. The supply of single-family existing homes for sale jumped by 17.8% over the same 12-month period, but the median sales price was still 4.1% higher than the level in October 2023. Okay, so there are a few questions that I would have about this. First and foremost, I don't like when the National Association of Realtors reports data because there's a clear conflict of interest there, right? Of course, if you're part of the NAR, you're going to report data that makes the housing market look better than it is. Now, I'm not saying their data is incorrect. I'm just saying perhaps we need to look into the validity of their data. If there's a clear self-interest in making the data look better for you, perhaps that self-interest was taken advantage of, and they utilized the fact that they are reporting the data to make their jobs and their lives much easier. Maybe, just maybe. Again, what do I know? But another thing to consider here is that supply went up by 18% approximately, and median sales price was still 4.1% higher. So that means prices have gone up according to this data, but supply has gone up way more than the prices. What does this mean? Well, from what I can see, when I look at houses, when I see listings, prices haven't gone up. Prices have actually come down. However, because this data is showing us it's 4.1% higher, the only way I can reason that that is the case is because the homes that are being sold, median sales price, the ones that are being sold are the ones that rich people can buy. And those houses are increasing in price because they're usually in locations that are incredibly desirable. They're not your average run-of-the-mill condo. They're not your average run-of-the-mill penthouse, like there are any of those. They're not your average run-of-the-mill suburban home, 3 bedrooms, 2-door garage, and a picket fence. They're not your average home. Average homes shouldn't be flying up in price. They shouldn't be increasing right now because nobody's buying them. Nobody's buying average homes. If you look at consumer sentiment, no one's buying. Nobody can afford it. People are tapping into more equity lines of credit on their homes, or they're trying to. They're getting rejected because banks are looking at them like walking landmines in terms of credit risk, but they're applying, which means that they need money. The people that do have homes, people that don't actually own their homes but have them. So if they own homes and they need credit, what does that say about the people who don't own homes, who would probably like to own homes? Well, they're not buying them because they're too expensive. And prices have come down, but we're looking at median sales price, the ones that are actually coming off the market, the ones that are actually flipping hands. The only houses that are flipping hands are homes that rich people can afford. Homes that people who are not being affected by inflation can afford. Homes where these people are in positions where their wages, their salaries are increasing, their stock options are increasing, their cryptocurrency is increasing, their real estate portfolio is increasing, perhaps their business is increasing in value. All of this is making them richer, meaning that they can afford a more expensive house. They don't care about a 4.1% increase. They made 40% on their stocks this year. Who cares about a 4.1% median sales price increase? That's the thing we have to consider here, because if you look at all this, you may say, oh, wow, single-family home sales are expected to slow, but overall they're up. They're up. That's good, right? Supply is coming online. But nobody's buying that supply. Nobody's buying it. So what does that do eventually? When these rates come down far enough, which they will, because even though we've had a bond sell-off as yields have spiked in October, as they usually do, and then November, following the Trump election, inevitably, they're still going to come down because they're still in a bear trend, or rather a bull trend in terms of price, bear trend in terms of yield. If you're looking for yield, it's very bearish for you. But overall, the asset class is going to be bullish. Bonds are going to be bullish. They're going to increase in price because the global economy is sick. Germany is failing. France is failing. Their manufacturing reports came out the other day, atrocious. France is deep in contraction and deepening every month. Germany is not far behind. The EU in general is very, very sick, and that will spill over to the United States, especially since the United States is sick as well. The data just doesn't look as terrible yet. But I believe that come January 1st, but specifically by the time March comes around, there will be no hiding this. The data will be that bad. And that's when you'll start seeing a lot of this data that's been shoved under the rug, because this is just an article. You can't fit the whole thing in, right? You can't tell the whole story. You're going to get through the bullet points that look good, especially whenever you're bringing up the NAR, the National Association of Realtors. Who wrote this article in any case? Oh, there's not a name. That's interesting. MT Newswires. I wonder who wrote it from there. Now, I'm not trying to accuse anybody of anything, but when other data is showing us that the housing market isn't doing well, when consumer sentiment is terrible, when debt is at an all-time high, when auto loan repossessions are at an all-time high, when jobs are disappearing, when people can't pay bills, when inflation is still hot, and when the global economy looks weaker than ever, I wouldn't see these numbers as good, especially whenever you look at the home builders' sentiment. It improved because they expect lower regulatory burdens. Great. But who cares? You can build all you want, but if nobody buys, it doesn't matter if the regulations are loose, you need buyers. And regulations don't increase buyers. You know what increases the amount of buyers? Having more income. Having better prospects for the future. Psychologically believing that things are going to improve as time moves on. They're going to be able to take care of your kids, that perhaps you're going to be able to buy a new car, that perhaps you're going to get promoted. All of these things tie into buying a new home. Or that perhaps you get some extra money, so now you can invest in a property. That's when you can buy a new home. Regulatory conditions be damned. Though they will be important, it's just that their sentiment only improved because of the hope of lower regulation. That's very vaporous. That's not a lot to go on. That's not really a castle built on stone in the middle of the Scottish forest, is it? It's more like a castle built on the shores of Virginia Beach. It's about to get knocked over by the first storm that passes in. So, with all this being said, I'm not an expert on the housing market. So take what I say with a grain of salt. I'm just covering the stories, letting you know what's happening in terms of the article. You could throw out everything that I'm saying. Fair enough. Because who am I? What do I know? Take the data as you will, compile it with other data that you find. But I'm mostly doing this, A, to inform you, but B, to also inform myself and see what the narrative is. And I believe right now with the Trump election, you're seeing this lackadaisical approach to the future. Oh, things are going to be fine. Trump's going to take care of it, blah, 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 blah. Wouldn't bet on that, especially when he actually has to take office and do things. Right now, it's all good because he's not doing anything. He's appointing people into positions, but those people aren't actually doing anything in their positions because their cabinet hasn't formed yet and the new government hasn't taken control and blah, 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 blah. Once they take control, now the timer starts. Now the pressure's on. Now the heat rises. What happens when in March the data is still getting worse? Trump has been in office for a month and a half, and now all of a sudden questions start coming. I'm not saying that's going to happen, but what if? These are the things I want you to consider. But with that being said, if you gained value to this, subscribe to the page. Let me know what you think about the housing market. Am I completely off base here? Am I completely off kilter? Maybe. Let me know. I'd love to hear from you. But if you agree, also let me know. Let me know what I can improve upon in future videos. And with that being said, much love, peace. This is the New Da Vinci. Have a blessed day.